Good afternoon, everybody. My name is Katie Ensweiler. I'm the Senior Marketing Manager here at Von Lehman CPA and Advisory Firm. Thanks for joining us today. Big thank you to Haran and Graydon for their partnership on this continued series. I think we're about 3 years running it at this point, and it's been very successful up to this point. Before I kick it over to our presenters today, I do want to go over a few housekeeping items. You'll notice we are launching a different platform. We are not on Zoom. So if you do have questions, just click the title of the event and you will be directed to our YouTube page where there will be a chat box and you can enter in any questions you have. We realize that this topic is top of mind to a lot of people, so we'll get through as many questions as we possibly can. But in the event that we are unable to answer your questions, we will be sending out the email address as well as the name and additional contact information for all of our speakers for today's presentation. Also, if you are looking to get CE credit for this, we will be sending out those certificates in the days to come. With that, I'm going to go ahead and turn it over to Paul, John, and Ben.
Thanks, Katie.
Thank you, Katie. Welcome, everyone. We really appreciate you being with us. It's hard to believe it's already 3 years, but we're into it 3 years. And we've just had some wonderful dynamic ERISA topics is what we'd like to think. But my name is Paul Carl. I am a vice president with Haran, 37 years, I can't believe it, in the retirement plan industry. First date on what John and I affectionately refer to as the dark side, U.S. Department of Labor. So we both built up this, what I'll call geeky regulatory aspect of it. Myself, for about the last, 29 years, if I'm doing my math correctly, I've been working with a variety of employers and employees, helping them with their retirement.
I'm John Kirk. I'm a partner at Bricker Graydon. We merged, a month now, so now we are now Bricker Graydon. But I am in the employee benefits and executive comp group. I deal with retirement plans, health plans, all sorts of things of all sizes. For-profit, nonprofit, for the last 20 years. Like Paul said, spent a couple of years on the dark side, moved over. The dark side is nice, but the better side pays better for sure.
Yeah. And I'm Ben Barden. I'm a senior manager at VL here in the individual tax space. So deal with retirement plans a fair amount. Of course, we're on the tax planning end. So. Yeah, and luckily in my case, I have never been on the dark side. I would not want to work for the IRS since, as John alluded to, it pays significantly better and probably less angry taxpayers.
Much fewer angry taxpayers. Oh, yeah. So today we're going to talk about Secure 2.0. We talked, if you joined us last quarter, we talked about it as well. Today we're going to talk more about the tax side of things. So items that impact either the employer or the individual with regards to tax credits and sort of things like that, or just, items that impact your ability to save for retirement. And so, we hope you all will enjoy. Cool.
Exactly.
I don't think we're sharing screen though.
So, Katie, can you tell our people?
You can go ahead and share your screen.
There we go. There it is.
There it is.
So we were there. Now we're getting back there. There we go. Okay. All right.
Excellent. So Secure 2.0, this is really iteration number 2. As we've mentioned already, in February, we presented for an hour. Katie will have details at the end of this program as far as accessing that session as well as this session. So a little bit of a refresher on the history and the background of Secure 2.0. This was part of the budget bill that Congress passed late in 2022, December 29th of 2022 to be exact. It was bipartisan legislation. So, total buy-in by both Democrat and Republican parties. And the whole idea is to really increase retirement savings. As we know, there's a retirement savings crisis in the U.S. And this is a huge leap forward in creating an opportunity to close that gap. That said, this legislation, parts of it took effect really prior to the effective date, interestingly. A lot of it took effect as of the effective date on December 29th, 2022. And then there's other components of it that are just rolling out or phasing in over time. What we wanted to do today is really highlight some key provisions in the Secure 2.0, and in particular, talk about what it means at an organizational level for your plan design, but then also the tax impact. And not only at, at the organization, the company level, but at the individual level as well. So, this session includes Ben, a tax expert at Von Lehman. And with that said, unless anybody has anything to add, we can jump in.
Yeah, I will say, just sort of as an overarching comment as to what Paul said, the goal of this legislation was to make it easier to save, to make it more, more incentives to save, and incentives for employers to start plans and create matches for their employees. Everything is geared toward trying to boost retirement savings. But also there's a couple of things in here we're going to talk about. It's also trying to help savings in general for employees. There's, you hear lots of times where they say, people don't have enough savings personally. So there are some things that they've done to help people with that, knowing retirement plans have a lot of cash that people may have put aside, but don't always have access to because of rules.
Exactly. So one of the first items that we want to address in today's session is the creation of new plans and related tax credits. A brief summary, and then I'm going to kick it over to John to explain further and Ben to get into the tax effects. But any participant-directed plan created effective 12/29 of 2022 or later, this provision affects that. And John, why don't you provide some of the details on those plans, which ones they are, and what the rules are.
Yeah, so the first thing I'll say is, if everyone remembers back years ago, it had been multiple years ago, at one point they sort of threatened everyone would have to have automatic enrollment in their 401k plans. And they even got so far as some guidance and different things, then it all sort of got pulled back. So if your plan exists today, if your plan existed as of the date the legislation went into effect, not a lot of impact on you. You don't have to do automatic enrollment. It's not required for your plan. This really means for brand new plans. So I've started the new company and I'm putting the plan in place. I'm an existing company that's been around for more than 3 years, and I'm putting the plan in place. It's not, hey, I had a profit sharing plan, I'm adding a 401k feature. It's not, well, we've had this plan for a long time. It really is brand new, newly hatched, we'll say, 401k plans. But for those plans, you're going to have automatic enrollment. And the reason the government's doing this is they found through studying plans that do have this, most employees, when it's an opt-out type of feature, they do not opt out. They just, we've enrolled you, we're putting in 3% of your pay. And employees get their first paycheck, they see 3% get went into 401k. And frankly, it's really more inertia than anything. There's like, okay, it's just another withholding. They get used to having their pay without that 3%, and it's going into the plan. And so very few employees actually go back and then change it. Once this is in effect, employees will have 90 days to go in and say, what, I don't want to be in the plan. And they'll have 90 days to tell you that, and they get a refund for that 3, 4, 5, whatever percent you put in the plan. There's also an auto escalator. It's not mentioned on here, but you will increase that up to different percentages each year. Again, most employees, they don't notice that extra 1% each year. especially presuming your wages are rising slightly each year. You know, the 1% doesn't particularly hit them. But in addition to, new plans, the Congress has decided, well, we're gonna give some credits available to encourage people to start new plans. And specifically, it's employers with 100 or fewer employees. You know, if you've got more than 100 employees, you probably already have a 401k, you've probably got some sort of retirement system. They're really focused on that smaller employer, which I think if you look at the census data, that's where a vast majority of employees across the country work, is a smaller employer who may not have those retirement plans. So they've got these credits for employers for, the first beginning of life for those sorts of things.
Yeah, and as John mentioned, as you can see on the lifespans here, they're all designed for the first 3 to 5 years that the plans are in place. There is a credit very simply organized for the automatic enrollment. If you have 100 employees or less, then you'll get $500 each year as a tax credit just for having the auto enrollment feature. And that actually, even though the requirement starts in 2025, that credit is available currently. So if you start a plan in 2023, has auto enrollment, as long as you have that provision in there, then you can get that $500.
And I was gonna say, we want to interrupt that. So any plan adopted, let's say you adopted a new plan January 1st of 2023, you do not have to have auto enrollment yet. But you better have it starting in 2025. But to your point, if you do put the auto enrollment in immediately, the credit is available.
Yeah.
And it's so essentially new and currently existing plans, if you put in the auto enrollment feature, you get the credit. Now, it's been said it's $500 a year, but if you're a small employer, tax credit's a tax credit.
Right.
Yeah.
$500.
It's not a deduction, it's a credit.
Right.
Yeah.
And the others are really designed with a similar approach in mind, knowing that you're going to have this requirement starting in 2025. So they've made the credits available now for companies that want to get ahead of the game. The biggest credit is for the new plan startup costs. Now that operates on a little more of a tiered approach. If you have 1 to 50 employees, then you can get a credit for 100% of the startup costs. But if you have 51 to 100, then you only get 50% of those costs. And once you get above 100, of course, it goes away. That would be a maximum of either $5,000. So it's gonna cap out at $5,000. But if you have less than $5,000, you have the option to do 250 times the number of eligible non-highly compensated employees. So it's possible for some companies, it might be less than 5,000. If, say, you do the 250 times those number of employees, that only comes out to 4,000, for instance, you could get capped out of that. That's also for the first 3 years. There is a credit for employer contributions, which actually applies for the first 5 years. That would be up to 100% of the employer contributions for the first 2 years, 75% in the third year, 50% in the fourth year, 25% in the fifth. So it basically ratchets down every year. Again, that follows a little bit of a similar approach where it's 1 to 50. Those are the rules in place. Once you get north of 50, it gradually phases out based on every employee above that level. And that would be maximum per employee of 1,000. It only also applies for employees that are making $100,000 or less. If I can just.
And one thing to point out to the 100,000, for all of these credits, to have them, you have to have at least one non-highly comped employee.
Right.
So really what that means is you can't be a solo 401k, so you can't be,
Yeah.
and we usually see these doctors, dentists, solo lawyers, some sort of paraprofessional type organization where I'm gonna start a plan for myself and put this money in. You can't get the credits unless you have at least one non-highly comped employee. Also, IRS sort of thinking ahead, you can't terminate your old plan and start a new plan and also get the credit. You have to start you can't have had a plan and start one. You have to have a truly new, brand new plan. The IRS likes to always try and cut us off if they can.
Give us the credits and then limit how you can use them.
That's right.
Exactly. Okay, so our next topic of conversation is, I think, of interest to a lot of employers. And that is with regard to the student loan payments as matching or student loan payments and matching employer matching contributions. Briefly, Secure 2.0 finally addressed from a legislative standpoint something that's been what I'll call a topic of conversation for at least 5 years, maybe longer. Time goes so fast, I lose track of things. But what it boils down to is if you have employees who are eligible to be participants in the plan or are participants, they're making student loan payments. You know, there's a good chance that they are not funding their 401k plan. So there's a provision here. John, why don't you go into detail what it all means for everybody?
Yeah, so this one, it's effective starting in 2024, so starting the beginning of the next year. And essentially what it does is allows, as Paul said, if the employees are paying their student loans and not putting money in the 401k, it allows the employer to treat those loan payments as if they had put the money into the plan, and you can make a match on those payments. So if you have a 3% match, you could match 3% for their loan payments. It's got to be a qualified student loan, as we say there. Essentially what that means is they've got to be enrolled at least half time. There's no requirement that they graduate, but it's not for room and board. It's not for non-credit type classes. It's for some sort of degree seeking credit at an accredited university. Employees can self-certify on this, so you don't have to dig into show me your transcript, which we do have for a lot of others of education assistance plans that you may have. We're not forcing them to say give us a transcript, show us a question. It's a self-certification, kind of like a hardship distribution if you're familiar with those in your 401k plan. But you will need to amend your plan if you want to do this. So it's not a requirement to offer this. It's not a requirement to do it. But if you do, you have to amend your plan. So you'd have to amend your plan, in a timely manner. I believe it's 1/1 by the end of 25 for this, even though it starts in 24. So talk to your plan sponsor, plan provider, talk to your attorneys if you want to do this. I will say just in general, as a benefits attorney, we get a lot of questions about this or how we can help with student loans, especially for the younger employees. This is, a lot of them would rather see some sort of student loan payment, frankly, than a little more salary.
Mm-hmm.
Because when they look, rent's number one, and then for a lot of people, student loans is number two. So if we could help offset that even a little, it's a nice way to sort of keep and retain employees.
Ben, is there any tax benefit? If the employee is deferring into a 401k, they could choose pre-tax.
Exactly.
And get,
yeah.
And
it'll follow the same logic as, essentially from a tax compliance standpoint, this is going to be the same as any other contribution into the retirement plan. It's just instead of going to them, their retirement plan directly, obviously it's covering their student loans.
Right, exactly. So some key points with this is one, it seems like it makes sense to adopt it. It is optional. So I guess point number two is it is optional. I'll just mention that, in talking to some of the record keepers that are out there, they're not exactly prepared from a technology standpoint to handle this. So if it's something that you do want to adopt, I suggest you get with your document provider, advisor, ERISA attorney, and figure out if in fact it can be implemented in a timely manner, number one, and number two, just be prepared that there might be some manual bookkeeping that takes place for a little bit.
I think that's right. And I think there's other things we'll talk about this afternoon where I don't think the service providers are quite ready for this. part of it is the IRS has already said we need to have more guidance on a lot of these topics.
Right.
Another part of it is, some of these amendments won't be due for another year and a half, 2 years potentially for the plans. So as you know, a lot of times the document providers sort of wait to the last minute to get those amendments. But if you want to do this, you need to operate as if your plan's been amended. So you still need to have the conversations with payroll and everyone else that can we even do this going forward?
Right.
All right.
Catch-up contribution, everybody's favorite topic.
Oh, goodness. So I think we all know what a catch-up contribution is. When you hit age 50 or older at any time during a calendar year, even on December 31st, you're eligible for a catch-up contribution. Traditionally, those contributions, you've been able to decide yourself if you want it to be pre-tax that grows tax deferred, or if you want it to be Roth that grows tax-free, provided it meets other provisions and so forth. The catch-up provision this year is $7,500 for anybody 50 or older, really nice. Secure 2.0 on one hand, notches that up a little bit. On the other hand, it creates a little bit of complication for certain individuals. So,
Yeah, and one odd offshoot of Secure 2.0 that the government said they're going to fix is when they passed this legislation, they inadvertently revoked all of the prior legislation dealing with catch-up contributions. Somehow when they did it, they deleted that provision from the tax code. So they're going to fix it. But theoretically, we only have catch-up contributions to the end of the year until they fix it. But the biggest issue here is, working with two issues. One, work with your providers, make sure we're capturing this because we have 7,500. When you hit that 60 to 63 starting in 2025, now it's 10,000 or 50% more than 2024. Reason it's that 50% more is this is indexed for inflation, so it could be it's above. You end up above 10,000. That's why it's the greater of. But the other issue is the second bullet point. Employees with comp greater than $145,000 no longer get tax-free pre-tax catch-up contributions. If you have comp higher than $155,000, the entire amount of your catch-up contribution is now subject to Roth. And this is mandatory. So, we just talked about optional plan provision. This is a mandatory plan provision. So you have to amend your plan, or your plan will be amended for this. And the other issue is, if you don't have a Roth feature in your plan, you need to get one. So you may need to amend your plan both to allow this and to have a Roth feature, so you can put these Roth now catch-up contributions into the plan.
John, just hypothetically, if someone does not have a Roth feature, does not adopt a Roth feature, do we think this will become a mandatory provision that will be in plan documents, or is it something that somebody earning more than 145,000 won't be able to?
I think what will happen is the big document providers and the smaller ones.
Right.
I think it may not be a sort of, we'll say, general Roth where everyone can do a Roth, but it'll be designed so that if this is triggered for these higher earners, a Roth account will be set up for them for this money. I don't really see any other way around it, because we can't just say you can't make catch-up contributions. Yes. So, and really, we're probably talking more your C-suite, some of your executives who are probably the last people we want to tell you can't make contributions to the retirement plan, especially as they're getting closer to retirement. So I think it'll trigger, maybe not general, but all of a sudden this person has a Roth account and this person has a Roth account. But I would think most people just go ahead and make a Roth account. For a lot of people, it makes sense to go ahead and do the Roth conversion. So that's a discussion with your advisors, but.
And then tax effect on this.
Yeah.
How do you see that?
I think the main thing is just make sure, I said maybe their C-suite and so on, make sure they're aware that is how it's going to be treated at their individual levels. So if they're used to maybe their wages being adjusted for having the catch-up contribution come through as a typical deductible 401k deduction. That's not gonna be the case going forward, so.
Yeah,
I just need to
especially,
be aware.
especially if it's $10,000. I mean,
Right.
before I was like, oh, I can deduct $10,000 when I make that. Like, oh, no, you gotta pay tax on this that goes in.
Right, yeah. So I mean, it's gonna raise taxes
Mhm.
for those making 145 and in effect, if they've been making
If they've been
pre-tax, right?
Yeah.
And then, you know, in effect, it's a tax revenue generator for the government, right?
It is.
Yeah,
Uh,
I mean, that's what it really boils down to. The benefit is leave it in 5 or more years. I'm assuming it's subject to the 5-year rule.
I haven't seen anything that says it's not subject to the
Right.
5-year rule. So you know, you're age 60, you pay your tax, you put it in.
Yeah.
You get to normal retirement age, you've got tax-free earnings on that.
So really thinking about it from a personal income tax, I mean, that's something to be cognizant of. If someone is, you know, older and has been pre-taxed the whole time, and all of a sudden they're making their first Roth contribution, but they're planning on retiring, they've got to be careful not to withdraw.
Right.
Yeah, withdraw that money.
And that is one of the things, you know, is we work with executive comp, you know, a lot of times we get involved in executive comp, but they also have an estate planning attorney and they have their tax advisors. And so we have to work all these together because we don't want, you know, what's designed.
Yeah.
The plan provisions, and also we screwed up something over on the personal tax planning side.
Right.
So the good news is they've increased the number,
Right.
so you can put more in.
Exactly. So this one, you know, there's been a lot written about, for the fact that it took effect immediately, in 2023, but the required minimum distribution updates. You know, it was 70 and a half, it raised to 72, and now it's 73. So, John, if you want to cover what this is highlighting, and then Ben, just maybe hit the tax effects here.
So the biggest news is the age. So it's 73 from 2023 to 2032. Then it kicks up to 75. So as your, you know, and it's not everybody, you know, a lot of people start drawing out of their retirement accounts, either whether IRA, this applies to all plans, IRAs, 401ks, 403bs, whatever you've got. But a lot of people are already drawing their money out. Now, maybe you're not drawing it out fast enough. Maybe you've got other income or other accounts and you're not drawing it out at all. That's when these required minimum distributions would trigger. And, you know, there's a set formula for how much you have to take out. But, you know, it keeps moving the years back. Now, when you're 70, you know, the way it should work is you're 73, then you're 74, and, you know, there shouldn't be any overlap. So it's the year you turn that age. So in 2033, those will turn 75. That's when that will trigger. And older.
Mhm.
The other thing that we like is one, and I'm gonna skip one, the excise tax on the failure to take your RMDs has been reduced effective the day of the legislation, so December 29th. So it used to be, if you missed that RMD, it was a horrendous tax hit.
How much, Ben?
50%.
50.
Yeah, so they
50%.
cut it in half, which is
Yeah.
very.
So if your RMD was 10,000 a year and you didn't
Yep.
take it,
You're
then who
paying-
was responsible? Was the employer responsible for issuing this, or was it the participant?
Well, the employee would ultimately be on the hook for it.
Yeah, so I mean, yeah, so half of that in that example, 5,000.
Right.
Yeah, so they've got to have, and if we correct it, it's only down to 10%. So we've now got an even better out, because it used to be, whether you corrected it or not, you were hit with 50% tax.
Right.
And that happens because, you know, you didn't know you forgot you had that account. Another reason you should probably roll everything over to one account or an IRA as you get there, but you forget you had the account, you know, someone died and that's an inherited type account. There are lots of reasons to miss, and then you get hit with this nasty tax. So 25%, if we discover it, fix it, it's only down to 10%. It makes it a lot. We still have to do over RMPs, but it does make it a little better should we inadvertently miss one. But the other issue is that a surviving spouse now can be elected to be treated as the employee. And the reason that's important is generally, there's a timeline to how long you can take, you have to take the RMDs, and you have to have the accounts empty. Now, the surviving spouse can potentially accelerate that if they older spouse who's deceased, or potentially slow it down if you had a younger spouse who was deceased. So you can sort of you can now elect to stand in their shoes for RMD purposes. So it gives you a little more control over your timing, life expectancy that's used in calculating this. And, helps potentially with, having that income coming in when maybe you don't want it coming in from the RMDs.
Yeah, and I mean, the biggest tax effect obviously is the excise tax, because it said before that would have been assessed at the individual level. So now in case those are forgotten or there is an issue, you get the 25%. As long as they correct it within 2 years, it's down to 10%.
What's unique about this provision, I don't want to say it was automatic that a surviving spouse might roll into an IRA and pull money out of the plan. But now it becomes a conscious decision.
Right.
That, the spouse should probably talk to a financial advisor and tax professional to figure out what is the best avenue.
Exactly.
Because John, help me out. If the surviving spouse decides to roll this money out of the plan into an IRA, well, either of you, I mean, now what happens? What's the effect of?
Well, if they're in the plan, they're following under the plan rules, and so they have these sorts of things. If you've rolled it into the IRA, you fall into the inherited IRA rules.
Yes, right.
And so you still have a little more choice, but it's a different set of rules than what you have under the plan.
Right.
So it really does become like I said, a conscious decision. Well, do I leave it here? Do I and use these rules? Because maybe that works for me. Do I roll it in the IRA, work under the inherited IRA rules, which essentially puts you in the place of the deceased person.
Right.
So for the most part, if we, in general, a lot of times the spouse is younger than the person who's deceased, not always, but so a lot of times that might speed up those RMDs because you're now in the place of that person. And that might be what you want because you need the income.
Yep.
But it may not be what you want.
Yeah.
You may not want to have that, because remember, you're paying ordinary income when that money comes out.
Right.
And if it's a sizable account, that's a sizable RMD, because they're trying to drain these things within 10 years.
And from a planning perspective, you definitely, regardless of what schedule you're on, the individual, they need to be in, pretty constant contact with their tax advisor about it and with their investment advisors, just to know what does their overall income picture look like? What's the hit going to be of having to take those either over a broader period or a short period?
Yeah. So while RFDs have always been a little complicated, they've come a little for you personally, but your RMD, not as bad.
Right.
But there's more now sort of on the back end once you're, we'll say, not in the picture, to how your surviving spouse is going to handle these. So that might be something you want to, as you're doing estate planning, as you're doing tax planning, you need to consider that. Like, well, if you're this age, maybe this is what you want to do. And maybe have a bit of a plan with your tax advisor to figure that out.
So before we move on, one other question that kind of a highlight. Plans could adopt a provision that allowed non 5% owners to defer the RMD out of the plan as long as the participant was still employed with the employer. So do these changes in age have any effect on that provision, or is that still in place?
That one I'm not sure of.
Yeah,
Well, I haven't
seen anything.
I haven't seen anything.
I haven't-
Moves it.
No, I haven't seen anything. I mean, for all of these, we said, they keep saying, the service will issue more guidance.
More guidance, right?
I think that's, this thing was passed on December 29th.
Yes.
It was talked about for a while, but it was sort of rushed through. I think that's one of those things that no one really dug into yet, but I think if they were going to repeal it or revoke it, it would have popped up at some point.
I think you're right.
I haven't seen it, but I'm not saying they won't do it.
Right.
But at least right now, sort of radio silence.
Could be another December 29th. This is.
Yeah.
They'll make it-
It'll be,
Never knows.
July 3rd at midnight or something, before it goes away.
Right, exactly. Okay, moving on to the next topic, hardship withdrawal rule changes. Hardships are traditionally something that's an emergency. People have been able, participants have been able to, if it's allowed by the plan, take a hardship based on, well, the IRS has published safe harbor reasons historically, although plans did not have to use those safe harbor reasons, they could adopt their own. But for the most part, they've used that. So, John, why don't you talk about the hardship withdrawal rule changes?
I think the biggest change is this self-certification. We talked about it in a couple other contexts, but it used to be somebody come and say, I want a hardship withdrawal. I'm like, well, why do you want the hardship withdrawal? Well, my house flooded. And let's see some proof. Let's see some proof of the house flooding. Let's see some proof of the cost. And so you were limited by all these sorts of things. And it was frankly an administrative burden to the plan because you have to go through all these hoops just to approve this distribution of money for this employee who's had a hardship. And I'm not saying there weren't people that tried to have hardships that weren't really there, but for the most part, most people didn't even know hardships exist until they had a sudden and unforeseeable expense. So they changed it now that we have a self-certification. Now, what most people have is just a form your employee has to sign that says, here's why the hardship exists. Flood, horrible sudden medical expense, those sorts of things, really, again, unforeseeable sort of sudden expenses. Eviction, not threat of eviction, but I'm being evicted.
Right.
Those sorts of things. They have to certify that the amount they're asking for is not more than they actually need to do this. So, if they're being evicted, they need $10,000. They can't get $20,000. They get $10,000, and then they have no alternative means to satisfy such need. So it used to be they'd have to take plan loans. They'd have to take lots of other things before they could do this. No longer do we have to worry about that. Now they just have to satisfy. I don't have any other means. Turn it in. And there you go. The one key here is self-certification, perfectly fine. However, if you, the plan sponsor, have direct knowledge that the circumstances don't really exist, then you can deny the hardship. And it's not, hey, I saw on Facebook, maybe not, or it's, my house flooded, I need this money, and they rent in a high rise, or my kid had a horrible injury and needs money. You know they don't have kids. This kind of sort of direct knowledge. There's no duty to investigate anything like that. It's simply it's not true.
So actual knowledge
Right.
that the request is in fact bogus.
That's right.
Technical term. Okay, do they have to deny the request, or may they deny the request? Or do we expect IRS guidance on
We
that?
expect guidance, but if they have if you have direct knowledge that it's not there, you should deny it. The reason being is hardship withdrawals have special tax treatment. And if your plan allows in-service withdrawals, not hardship withdrawals, but it's the normal in-service withdrawal, you'd have to direct them there. And in that case, then they have to pay the penalty. They have to pay all of the things that come with taking a distribution prior to 59.5. And a lot of plans don't have in-service withdrawals, so maybe they couldn't even get their money. The hardship and the certification for the hardship allows us to take the money out without having to worry about the penalties. And so as a plan fiduciary, I think it's your obligation to, if you have knowledge, you've got to deny that request. Now, maybe they have the ability, they do have the ability to rebut it,
Mhm.
but at least first go around, if you're like, listen, I know you don't have a car and you can't tell me your car blew up, like it's not gonna happen.
Right, and not really any change, of course, from the tax impact, since before we still have these, that's just changed the way that it's certified.
So,
Yeah.
so they're not tax-free, they're still taxable
Yeah.
distributions, withdrawals. And
Yeah.
And so forth. But again,
But you get it right though.
hardships, offering hardships in your plan, one is optional. And it's not a protected benefit. So if you offer it and want to pull the provision out, you can. Two, using the self-certification is optional as well. So there's nothing that says you have to.
That's right. You don't have to. Most, and the vast majority of plan sponsors do though. Again, to make sure, it's to lessen the administrative burden on your human resources department or on your record keeper. You know, so you're not having to provide documents. It's easy. Here's the form, fill it out. Okay, if you checked all the boxes, you know, we have no knowledge, take your hardship and go. And plan sponsors sort of feel that way. It's the employee's money. You know, our goal is to have you set for retirement, but if you do have an unforeseeable expense, like, we shouldn't be the obstacle to them having that money. And that sort of leads us to the next thing where they've created new distribution rules for other options. So if you are a domestic abuse victim, you can get up to $10,000. It's actually the lesser of 10,000 or half your account balance. It's a self-certification. There is a definition of abuse, but it's pretty much the definition you would expect for domestic abuse. It applies to you, the individual, to your children, and to any other family member that lives in your home. So if, you know, many times you hear abuse victims say, you know, I can't leave the person because I can't afford it. Now they potentially have a source of income that's not, you know, controlled by the other person. They can take this money out, use it to get back on their feet, escape, whatever it might be. These are all withdrawals you can take. They're not hardships, these are new things, but again, no penalties. You don't have to pay the penalty on the early withdrawal. You can take money out to pay long-term care contract distribution, contract premiums. So it's the lesser of the amount of the premiums, 10% of your account balance or $2,500. And then you can also take out money for qualified birth and adoption, qualified birth or adoption distributions, but you can also repay those. And so you have 3 years to repay them. And if you do repay them, so you can take the money out, you'll pay your ordinary income tax on it, no penalty, you pay the ordinary income. If you repay it, you get a refund of that tax. And so that actually applies now. So anybody that took a qualified birth or adoption distribution, you know, the clock's ticking on your 3 years to repay it.
Right, yeah, that's effective, right?
Yeah, as long as they repay.
Right, yeah.
So, you know, again, we just said, you know, it's their money, we're trying to not stand in the middle of it. So the IRS now added some new reasons you can take it out. The long-term care contract, sort of, so like domestic abuse seems, or, you know, qualified birth adoption, then that, you know, I've entered into a long-term care contract. But the reason for that, at least the reason I've heard given, is that a lot of people, because of retirement, they'll have a lot of retirement savings. Long-term care may be important, especially as, you know, people live longer and maybe have more health needs. And so and frankly, I mean, you know, my parents have a long-term care contract and those premiums keep going up and up and up and up. I told my mom it's because she's beating the odds by living longer. You know, they rolled the dice on her and she's costing them money.
Right.
So they have to, but they keep raising the premiums.
Yeah.
So this is a way to sort of help lessen those premium rises and those costs of those accounts.
Exactly.
All right, this is emergency savings.
Yeah. So next topic, emergency savings withdrawals. This is a new provision. You know, fact of the matter is, unfortunately, a lot of households don't have even a $1,000 emergency fund. Something that I believe our financial advisors, you know, get the emergency fund in place first and then proceed from there, because you just never know what's going to happen. And so now Secure 2.0 puts, I believe, an optional provision in opportunity into the plan. So John, why don't you talk about the highlights of it, and Ben, you know, talk about the tax impact, if any, to.
Yeah, so this goes back to what we were talking about, is like a lot of people, Paul said, don't have savings. Legislature trying to encourage that, allows a withdrawal from the plan up to $1,000. You can have not subject to the penalty, has to be repaid, much like the birth and adoption. But you self-certification, everything's going to self-certification because the IRS is trying to ease the burden on the plan sponsors. And put that burden on the employees. But the only reason they couldn't take this is one, your plan doesn't allow it. It's optional. So you amend your plan to do it, but also they have to have repaid any emergency withdrawal previously. Or 3 years have passed, or they've put contributions into the plan that equals the amount of their prior withdrawal. So it's not like you can just pull people on $1,000 every year. You can either repay it 3 years have passed. So it's a way to get $1,000. You still have to pay income tax. So really, depending on your effective tax rate, you're getting less, but you don't have to pay the penalty.
Right, exactly, yeah, and operates similar to the other ones we addressed, no penalty, still tax, as long as you pay it back, you can get around the tax. One thing that, might be worth advising any employees that go through any of these withdrawals is that, because it is a self-certification now, in the past, they might have had to provide more documentation up front to support that it would be penalty free. Just because they don't have to do that currently in order to get the distribution doesn't mean that down the road, if there's some sort of issue and the IRS comes looking for, hey, do you have proof for this? They would still need to have that proof personally. So as long as they're aware that is still something they need to be able to document if called upon, they don't need to provide it now. It lessens the burden on the front end, but they'll still have to do it.
That's right. And for these emergency savings withdrawals, it's not like a hardship where sudden you can say, hey, I need this money for whatever, hopefully not beer or buy.
Right.
That's some support.
Yeah.
It's your refrigerator went out, or you need a couple of tires, something.
Kid
Yeah,
cracking his teeth out, and now I gotta get ungodly expensive braces and everything else.
exactly.
But again, you need to amend your plan to allow it, talk to your service providers, make sure they can allow it. You, the employer, should make sure for any of these kinds of distributions, you keep that self-certification form, stick it in the personnel file, stick it in your plan file, wherever you store those. Because if the IRS comes, they're gonna ask you for that form, and you're covered if you have the form. They will then go talk to the employee on a personal, individual level about,
To make sure, but they.
Right.
the income and those sorts of things.
Right. So this is a new provision as well, pension linked savings accounts. We're getting close on time. So just briefly, you want to highlight?
Yeah, we're almost there.
Yeah.
But again, trying to increase savings. This would be a savings account within your 401k plan, within your qualified plan for non-highly comped employees. They can put up to $2,500. It's up to 3% of pay, but it's capped at $2,500. It's only available in individual account-based retirement plans. The reason, we can't do it if you have a 403B that is usually group annuities. We couldn't put it in there.
Right.
It's got to be individual accounts. They can pull it out for any reason. Frankly, it works a lot like a regular savings account. They can have up to 1 withdrawal per month, 4 withdrawals. This sounds like the bank. 4 withdrawals a year, fee free. The money can be invested. The money's limited, so it's not like it can go into your normal investment accounts.
Right.
It's in cash, interest-bearing accounts, or principal preservation accounts. So if you decide to put these in, it gets mandatory. If you decide to put these in, you need to make sure that those investment options are limited for those accounts. So work with your plan financial advisor to make sure it's we're not in the high capped index international fund. We're in cash, money market, interest bearing.
Tend to be a savings account. Does it count towards your deferral limit?
It
does not.
It does. I would say it does not.
It does not.
So you do get a match on the money. So even though it doesn't count towards your deferral limit, you do get a match, but the match goes into the plan, not the savings accounts.
Right.
So that's a little twist that you also get. Your service providers are going to have to be up to speed on these things.
And they're not yet, so.
That's right. And
And more guidance coming.
yeah, but there's no pulling money out of this. They would have ordinary income. Yeah, there's no penalties I'm aware of.
Yeah.
Again, optional. We can,
Just briefly, involuntary cash outs right now, plan can allow provisions that up to $1,000 can be cashed out. From 1,000 to 5,000 can be rolled over into a forced IRA. That limit is changing and going up to $7,000. That'll take effect January 1st, 2024. Briefly, it's a great way to clean out some of those terminated participants, lower account balance. And just a great way to keep your plan clean, so to speak.
yeah, I mean, this is money that belongs to people who are no longer employed by you, are still in your plan, so you're still paying admin fees on it, you're still paying all those sorts of things. If you haven't gone into your plan recently in the last several years and sort of I'll just say sweep it out.
Right.
You know, it's time to do it. You know, work with your custodian, and they can, you know, set up these forced IRAs and move them out.
And a lot of providers, a lot of the record keepers and service providers, they will automatically go through 1, 2, maybe even 3 times a year and switch these low balances out. So
And the other thing is, if your plan has some number under 5,000 or well above, you know, make sure your plan allows you to do this.
Yeah.
And move that number to the maximum number. You don't want to keep those little accounts in your plan.
Right.
They cost you money, and they cost administrative time.
exactly.
Okay.
Okay, we need to stop sharing.
So,
Sadie, is there any questions? We didn't allow much time, but
We do not have any questions. I think you guys just covered the topic too well.
okay.
Do you guys have any final thoughts you want to go over?
I'll just mention Secure 2.0, over 90 provisions, more to come. It's just we're trying to highlight what is going to be most impactful from plan design aspect as well as operationally and a tax impact. So, I just thank everybody for joining this.
no, I think it, they've tried to make things easier, but I think it's making it slightly harder on plan sponsors. I think for employees, the access to your money has gotten easier. For plan sponsors, more things we have to do, amend your plans, decide on optional provisions. So, make sure you're working with, service providers, tax, financial, legal, record keepers that you can work with, and that they're, the other thing is make sure they're administering your plan the way you want it to be. If you don't want one of these provisions, or you do, you need to do a check on them to make sure it's occurring.
Yeah, and in the long run, obviously, I think it will be more beneficial for the employees. And even once all the amendments are done, it's more work on the front end for, well, everyone in this room and, probably everyone on the call, but give it a few years and it'll wire itself out. It's, for once, it does seem to be something that it is meant to make things simpler in the grand scheme.
Yeah, no, I think this is a good effort by the IRS. It's been talked about for a while. We got it passed. We'll wait for the more guidance.
More clarification.
More clarification.
Then we'll get secured 3.0.
Yeah,
Right. Exactly.
make it a year later.
Sounds like this is just a series that's just going to keep on giving then. So good.
That's right.
Guys, we're going to keep using you. So huge thank you to Bricker and Graydon and Haran for your continued partnership on this. Ben, as kind of more of a guest speaker on behalf of Von Lehman, thank you for being here. Paul and John, thank you for the insights. We will be sending out the contact information for all 3 of our presenters today, in case you guys do have any follow-up questions, as well as the link to the recording. So with that, that is the conclusion of our presentation, and we thank you for your time today. Enjoy the rest of your day.